Hey folks, how's it going? A little over a week ago, I did a video about how about 84.5 billion in deposit flight was recorded in Q3 earnings from JP Morgan, Wells Fargo, and Citi. Now, at the time of that video, as a total across the entire banking sector, deposits dropped from 18.203 trillion in August of 22 to 17.365 trillion by October 20th, 2023. Now that's across the entire banking sector. If I'm not mistaken, that was worldwide. Now, so you're looking at almost $1 trillion worth of money that's no longer on deposit in banks. The article I'm talking about today is from the Daily Huddle. The link will be down below. It's gotten worse. Let me just put it that way. 100 billion in deposits exit U.S. banking system in 3 weeks as Fed survey says banks face financial stability risks. All right. People and businesses are withdrawing billions of dollars in deposits from U.S. banks as a new survey details concern on the state of the financial sector. The latest numbers from the Federal Reserve Economic Data, FRED system, show that deposits in all U.S. commercial banks suffered a $100 billion decline in 3 weeks. Let me repeat that. The latest numbers from the Federal Reserve Economic Data system shows that deposits in all U.S. commercial banks suffered a $100 billion decline in 3 weeks. From 17.38 trillion on September 27th down to 17.28 trillion on October 18th. $100 billion decline in 3 weeks. That's massive. That's not a small amount, folks. The deposit flight comes amid a new survey from the Federal Reserve that polls 25 participants, including market professionals, academics, investment funds, and research and advisory firms. The participants say that while the sector may have withstood financial tremors early this year, banks are still at risk of another crisis for 2 key reasons. Although survey respondents noted the banking sector has stabilized since the period of acute stress earlier this year. Let me adjust this camera a little bit, folks. Sorry, I'm trying to get some of that glare off of here. There we go. That's a little bit better. A little bit crooked, but there we go. All right, so as I was saying, although survey respondents noted the banking sector has stabilized since the period of acute stress earlier this year, many highlighted risks of renewed deposit outflows given the large portions of deposits remain uninsured. Again, many highlighted risks of renewed deposit outflows given that large portions of deposits remain uninsured. Many respondents continued to link risks of re-emerging banking sector stress to potential losses on CRE, commercial real estate, exposures, particularly among smaller and regional banks. Remember, at the first of this year, the banks that were hit hardest were those small regional banks. Participants also view the commercial retail sector as a potential trigger for systemic stress amid higher interest rates and declining demand for office space due to the shift to a hybrid work environment. Survey respondents viewed small and regional domestic banks as particularly vulnerable due to their higher concentration of CRE exposures, which could lead to tighter banking lending conditions. According to this, they're saying that the stress from commercial real estate is the biggest concern for smaller regional banks. But what I want you to focus on is the fact that 100 billion in deposits was lost within a 3-week period. And I don't mean lost as in it just poof, it just disappeared. What I mean is that people are taking that money and they're moving it out of deposits in banks and transferring it into other assets that are safer, if there is such a thing in this economy. Some people may be investing in treasuries. Treasuries themselves are a nightmare at the moment. Certainly not something I would consider safe. But to be honest with you, if you look at the repo windows, the Fed and the Treasury Department, they're not able to find buyers for all of the U.S. Treasuries like they normally would. That's why you're seeing yields go up and up and up. The costs are going down, and people are still not buying. And the reason they're not buying is because of the massive amount of debt that our country has racked up, and the uncontrollable spending by our government. And that sun is just, let me see if this will help a little bit. And it didn't help that much, did it? All right, so yeah, there we go. Sorry about that, folks. Another thing that I want to point out is that there are other warning signs of the crisis coming. We're seeing a tick up in the unemployment claims in some states. We're also seeing a lot more companies starting to lay off. In fact, Delta alone has just, I don't have the article in front of me. I'll include the link to that below. But Delta has just announced the Q3 earnings. They had a profit of like, I think it was like 1.1 billion for the third quarter earnings. However, they followed that up by saying that they are also going to start laying off corporate employees. Now, they didn't say how many corporate employees they were going to lay off. This is not going to be frontline workers. It's not going to be the staff on the grounds at the airport or at the checkout lines, what have you. These are going to be corporate office positions. But the indication from that article, and if you understand what's coming, you'll understand why they're doing this. They've started making record profits. Well, I wouldn't say record profits. They started making more profits. The profits are up from last year. I believe last year they had made $695 billion for the entire year, if I'm not mistaken. Or I might have that number mistaken. It might be that it was 695 million for the third quarter last year. I think that's what it was. Forgive me if I've got those numbers wrong. I don't have them right here in front of me. But profits were up this quarter over last year, and they understand that they're in a more stable position. However, they do see major headwinds coming for their industry over the next year, primarily from operating costs and fuel costs for the planes. Then there's also the geopolitical tensions. You know, they're going to be losing certain markets that they can normally fly to because of all of the conflict. So they're looking at inflation, rising prices, particularly with fuel, rising costs. So they're looking at cutting expenses now ahead of time so that they can be better prepared to withstand the coming economic conditions. A lot of people, I noticed when I was looking at that, a lot of people were commenting about the headline alone. And they were blaming it on greedy shareholders and making $1 billion in 3 months, and then turning around and firing people right here before the holidays too. And I'm not going to argue that there could be potentially some greed at play there, but as I've said before, a company's business is to maintain profitability, and that makes it important for them to look ahead. All companies, when they're making decisions on whether to lay people off, whether to hire people, they're not looking at what they made over the last 3 months or how business was over the last 3 months. They're looking at the next 3 months, the next 6 months, the next year. And they do that because that's what they have to base their projected earnings on. And if they see a potential downfall of profits, certain things that impact their business, then they have to make adjustments ahead of time to try to remain profitable. Otherwise, they're going to have a lot of shareholders to answer to. A company will not remain in business if it doesn't stay profitable. Unless you're one of the exceptions of these companies that seems to live off of government bailouts every single year. But what they're doing, a lot of people aren't looking at the article. They're not looking at the projections for the next 3, 6, 9, 12 months. They're thinking about, well, they made $1 billion in the last 3 months, so they shouldn't be laying anybody off. Just because you made $1 million or $1 billion in the last 3 months, that doesn't mean anything about what you're going to make for the next 3 months. That's what businesses have to look at. And it's a warning sign, at least to me, it's a red flag that they're already looking at future costs, and they're already looking at cutting any unnecessary positions. I think that's going to be something you're going to see a lot more of, particularly with the fact that we seem to be in another war now. We're going to be doubling our spending on foreign wars, racking up even more debt on top of what we already have. That's just going to do more damage. That's going to make the crash, when it comes, that's just going to make it even harder. And it wouldn't surprise me if they've managed to kick the can down the road for a certain amount of time already. It wouldn't surprise me if this new deployment to Israel, along with the current fueling of the war in Ukraine and potential conflicts with China or North Korea, those could be the very thing that push our economy right over the edge. So bear that in mind, folks. The warning signs, the red flags, the warning lights, they're all going off. They're going up everywhere. And they're there if you know what to look for. If you're not seeing it, it's either because you don't understand what's going on or because you're choosing not to see it. And I'll be honest with you. Complacency and bias can blind a lot of people. Normalcy bias is a very real thing. People look at the world around them and they think, oh, it's going to be like this. This is exactly the way it's going to be for the next 10, 15, 20 years. You can't go by that. You have to actually pay attention to what's happening around you. You have to look at the warning signs so that you can get ready. All right, with that's all I've got. I appreciate you guys watching. Like, share, subscribe if you haven't. And as always, keep prepping, stay safe, take care of yourselves. And until next time, folks, I'll catch you later.